morning to our wonderful audience and welcome back to Boutiques on Wednesdays. It was really great to see so many of you in person at our road shows the past week. Maybe for those of you who missed it or couldn't make it, we recorded the Pretoria and Cape Town sessions and we posted those recordings with the presentations on the Boutique Manager's website. So if you want to go look at those presentations, or if you were there and you want to go recap on some of those topics, more than welcome to go have a look there. Today, we will look at global equity and global fixed income. And it is my absolute pleasure to introduce two top fund managers in their field, both who needs very little introduction to this audience. Paul Crawford from Fairtree and Chief Investment Officer at Ranmore Fund Management, Andrew Lapping. Good morning, gentlemen. Thank you so much for joining us this morning. Very early start your side, and I believe 1 degree Celsius and still very dark in London. Morning, Paul. Morning, Andrew.
Morning, Eugene.
Andrew, just for our audience, Andrew joined Alan Gray in 2001, and as Chief Investment Officer, left there to join Ranmore in 2021, with Sean Pescius on the line as well. Sean gave us great insight to the Ranmore Global Equity Fund. That was about 2 weeks ago. But Andrew, I believe you're going to focus a little bit more on Ranmore, what makes you unique and why you should be a top choice in clients' global equity portfolios. Paul, we all know what you talk about. I mean, if we think global credit, we think Paul, and vice versa. If we hear Paul, we think global credit. Paul, you are up first. If you want to, you can start sharing your screen.
Is that coming up, Eugene?
Absolutely perfect. And you can start when you're ready, sir.
Okay. We're under a bit of time pressure this morning. We've got 15 minutes. I've got quite a long presentation. But hopefully, out of a rather slightly more balmy Chelsea this morning at 6 degrees, I'll see it as this morning outside. Yeah, good morning, everyone. So here we go. So I'm going to talk specifically about the BCI Fairtree Global Income Plus Feeder Fund, and I've entitled this presentation Fund Management and the Dunning-Kruger Effect, which we'll talk a little bit about later. Okay, there's a disclaimer which we won't talk about. So what am I going to speak? We're going to speak about the fund. This is actually just going over what I said last month. It's just to revise, to sort of a revise and review. I'm going to talk specifically more about histograms and why they're important. We're then going to have a look specifically under the hood of the fund. So I'm going to get a little bit more specific, a little bit more detail, but I won't take long on that. And then we're going to talk a little about UCITS and BN90. And should investors care about the overall sort of legislation which governs the funds that they manage? I would determine absolutely yes, but others might think differently. I think it's quite pertinent right now, given the news flow that we've had over the last few weeks with regard to what's been going on with certain funds within our category. I'm then actually going to finish off with a little bit of conclusions. So hopefully all in 15 minutes. So here we go. Let's talk about what this fund actually is. Well, the BCI Global Income Plus Feeder Fund, as it says on the tin, it actually feeds directly into our Global Income Plus Fund. That is a euro-denominated global UCITS fund. So what the feeder fund does, it allows rand-based investors to get access to our euro-denominated UCITS from South Africa. It just makes things easy for you. You don't need to externalize accounts. You don't need anything. It started almost 5 years ago, by the way. We're coming up for a 5-year anniversary, which is pretty cool. So you're going to start seeing some 5-year performance rather than just out to 4 years when you look at your Glacier numbers, which come out every Friday. It's also a roll-up fund. I've said this before. So it's got preferential tax treatment. So it's a capital instrument, which is pretty good. Its benchmark, I've said before, is there are obscure iTraxx crossover 5-year total return index. This is the most fungible, the most tradable, the most understood credit equally weighted index, which is pretty cool in Europe. It's our favorite sort of litmus test when we actually gather or try to work out what the market sort of risk appetite is in the globe. And that has got 75 equally weighted liquid credits. It's reconstituted semi-annually. It's been going for 20 years. So it's not a new index, let me just tell you that. And it's a total return index, which is pretty good. Yeah, so it's well understood, as I said, well understood, well traded, extremely liquid. It's got all the attributes which the CFA Institute would determine would be a good index. It also, as I say, I've said many times, it doesn't actually suffer from domination of specific counters in it because it's equally weighted. So that means you get the full benefit of the central limit theorem, which I've spoken about many times. I'm not going into that again. But anyway, it's a great index. Yeah. So anyway, let's have a look at some histograms. So I showed this last month, and I'm going to show it again because it's actually quite damn important, in my humble opinion. I think our sort of industry spends a hell of a lot of time on point forecasting. It really is. It's like bizarre. Everybody's like forecasting this for earnings, forecasting that for returns. It's bizarre, right? What really matters is not just, the mean of a distribution. It's also quite important. It's variance, or its standard deviation, or its risk. So what we've got here is we've got histograms of quarterly returns going back to Q2 2007. So we're talking 16 years worth of data, which is quite a lot, right? It is quarterly numbers, but be that as it may. So these are histograms of all the major global indices: the Dow, the Nasdaq, the FTSE, the European SX5E, which is the equivalent of Dow Jones in Europe. I've got iTraxx crossover. I've got the levered crossover as well. iTraxx main, which is an investment grade index. I've got the top 40, which everyone's quite aware of. I've got the ALBI, and I've got US Treasuries, all in different colors, all in the same histogram and smoothed. These are in local currency. So obviously, the narrower this distribution, the more certainty you have. The more volatile indices have got much broader distributions. They almost become almost like random. A random distribution would be a flat thing. So there's what we've got. So that's what they look like in local currency. So if we actually translate that into return and a standard deviation of those returns, so I'm looking at means and standard deviations, we get this. These are in local currency. So you can see that the top 40 has produced 9.31%, which is shown here, with a risk or a standard deviation of 16.05% annualized. These are logs. So the good news about logs, I can add and subtract and all those good things. I prefer logs than sort of simple algebraic sort of numbers. So there we go. That's all. So you can see when you look at these numbers, the top performer since 2007 in local currency has been the Nasdaq, which has outperformed the top 4 quite handsomely. The risk is significantly higher though, if you have a look. Yeah. Going along, FTSE, the major underperformer with the SX5. Europe and the UK has done terribly, relatively speaking, to the US. iTraxx crossover comes in at 5% per annum, and with a risk of 9.54. ALBI, everybody's darling in South Africa at the moment, 8.24% with a risk of just under 8. And then US Treasuries, the aforementioned sort of risk-free, which isn't really risk-free, 2.58% with a risk of 5.47. Now, this is quite interesting because the risk is actually dwarfs that of the iTraxx main, which is a investment grade global index. So the equally weighted corporate bond index, let me just say that, has got less volatility than US Treasuries, contrary to what most people sort of believe. So credit, paradoxically, is actually less volatile than the US Treasury total return index. Anyway, once we've done that, once we've actually had a look at them in local currency, it's always good to have a look at them in rands because you're rand-based investors. Now, this is what comes back. Everything converges to basically the same sort of risks. So you've still got the ALBI is shown. If you have a look at these one at a time, it's the same curves, it's the same scales, but these are now in local currencies. Everything sort of converges and flattens. Let me just say that. Yeah. So if we look at them in rands now, so what I've got returns in rands of the different indices, as well as the risks in rands, because you are rand-based investors. You can see this spits back. The Dow Jones produces an increase to 15.8% per annum. with a risk of 14%. The NASDAQ almost 19% per annum with a risk of 17%. So these numbers absolutely dwarf local equities. And some of them actually outperform with lower risk, which I find quite fascinating in itself. So the convergence of risk, the risk domination of the Rand, US dollar and Rand Euro exchange rates actually dwarfs that of the underlying indices themselves. What becomes quite even more interesting is iTraxx crossover credit, the index that we follow, has actually outperformed local equities since 2007. And it's done so at quite a much lower standard deviation. US Treasuries has produced the roughly top 40 total returns with higher volatility, which I also find interesting. Now, this one looks at differentials. So let's actually set our base at the top 40 total return index. So we zero the returns and then reference everything to that. So these are additional returns to the top 40. And then the next line shows you additional risk to the top 40. So everything's shown on a relative basis. So again, the Dow is outperformed by 6.5% per annum. The NASDAQ almost 10% per annum. The FTSE's underperformed. The SX5E is underperformed. iTraxx crossover has outperformed. The iTraxx crossover times 2 has outperformed rather well. The ALLB has underperformed, and US Treasuries have shown basically the same number. If we look at risk, this is the relative risk profiles of these different indices. You can see that the Dow Jones has less risk than the top 40. The FTSE has less risk. The NASDAQ and Rands has got slightly more risk. iTraxx crossover, substantially less risk. iTraxx means substantially less risk, and then obviously the ALLB and Rands less risk. So I find that quite fascinating. So this is a slide which I decided to put on after the Glacier numbers, which were produced on Friday. It just shows you the BCI Income Plus Fund, which I'm not really talking about. That's got a much longer track record, coming up for 10 years in a couple of days' time, actually. This shows the performance of the thesis that we've had, how we have actually managed our funds. And quite frankly, Friday was the first time I've ever seen actually a full house like this, where the fund has showed best performance in the 1 year, 2 years, 3 years, 4 years, 5 years, 7 years, and we're coming up in 10 years next week. And it should actually come in at number 1 as well in the 10 years. So, and there is the number of investments in that category. So it's first out of 132, first out of 126, first out of 121, first out of 106, first out of 95, etc. So it's been quite a good time. If we look at the Global Income Plus Fund, where what have I mentioned that at the end of the day, the fund is managed on a very similar basis to the way we manage the Income Plus Fund. In fact, it's just a global equivalent of what we actually put into our local BCI Income Plus Fund, the mandates, the way we manage, the thought processes, the algorithms used, how we conduct ourselves, how we choose assets, how we mix those assets is exactly the same. Okay, so there's the BCI Income Plus Global Income Plus Fund, should I say. It's 1 year performance just shy of 20%. So you can see it's outperformed our BCI Income Plus Fund quite significantly. 2 year numbers, 18% per year, 3 years, just over 9%, and then 4 years, just shy of 10%. The 5 year number comes out next month. Okay, so let's look under the hood quickly. This is just a little diagram showing you how it works. You all probably know this. I'll be very quick. For the Rand-based investor, he puts his Rand-based investment or his cash into the Global Income Plus Feeder Fund, which has a Rand bank account, buys a couple of money market assets for liquidity purposes, and then buys Euro assets. So Euros are purchased with Rands into our offshore account. The offshore account then actually buys units into the Fairtree Global Income Plus Fund. That Global Income Plus Fund produces Euro-based returns, which are then translated into Rands, and then the Rand performance goes back to the investor. That's what you see. So putting some meat on the bone, what does the fund look like? Well, it's 96% exposed to the Fairtree Global Income Plus Fund. It's got a little bit of money market just for liquidity purposes, and it's got about 1% cash. So about 4% in rands, the rest is in euros. That's what it looks like. Why do we need that? Well, people actually come in and out trying to play currencies or whatever they're trying to do. And then it's a buffer to actually generate a sizable amount before we transfer it. Obviously, you can't transfer £2.50 into euros because you can't get a deal in that sort of size. So we generally build it up to 1 or 2 million euros and then transfer over. So what's the story with the actual Global Income Plus Fund? It was launched some 5 years ago. Its benchmark is the total return index. It's a spreads capture fund, so we look to generate a Euribor plus a spread. I want to state that all of our unintended FX risk and interest rate risk is hedged. We do that using listed futures. What do we invest in? Corporate bonds, bank instruments, index-linked notes, tranches, SOEs, and from time to time, even government bonds. The concentration risk of that fund is as per the UCITS 5-10-40 rule, which is a lot more stringent than the BN90, which legislates the CISCA funds within South Africa. I'm going to talk a bit about that now. I just want to state this. There's been a lot of noise in the market recently about side pocketing. This fund has never side pocketed. In fact, no fund I've ever managed has ever side pocketed. So that makes the performance history real. It's not the good instruments and the bad instruments are side pocketed. All the performance is real. So all the numbers are real. Yeah. So let's have a look at the headlines of the Global Income Plus, because remember, the feeder fund feeds itself into this fund. It's about 70 million euros. The important thing you need to know, it's got 45 positions and it's got 353 obligors. So it's got 353 underlying exposures. That's what it is. It's got a weighted average spread right now of 360 basis points to Euribor. That translates to sort of JIBOR plus about 390 basis points. That's on a before fees basis. It's got high levels of liquidity. I just want to say that. It's got a 14%, around about 14%, cash and very, very liquid assets in it right now. Sudden default exposures. These are our exposures to individual names. I'm not going to go through this. It's the way we look at things. I mean, at the end of the day, our highest default exposure is to Northern Trust. That's where our cash is sitting. And then everything else shows you in euros, essentially where our exposures are. You should recognize a lot of these names. Look at it in your own time, and then you can call me if you need, or send me an email. And this is essentially where those, I don't need to talk about this. Right. So when we look at the fund and we actually represent the assets in that fund on a risk and spread, which is a proxy for par spread, is a proxy for risk, and size, I look at the positions in this rectangular plot. So if you look at if you watch my tracer here, if you look at the y-axis shows the par spread of the instrument. So the riskier the instrument is, the taller the exposure is. And then the x-axis actually shows you the exposure that we've got. Think about this as broad as big exposure, narrow as small exposures. So you can see a lot of small exposures. And then risk is shown in the y-axis. Anything multicolored is an index-linked note. So all these multicolored assets are all things which are linked to the very benchmark that we follow. Oh yeah, okay. So the risk is predominantly European risk. I don't really tell you about that. It's a European index. If you've seen a whole lot of other stuff in it, it wouldn't really be a European benchmark, would it? And the risk in per sector, you can see there's a nice sort of spread of different sectors within this portfolio. So yeah, so it's a nice cartwheel there. And if we look at the names, remember there's 353 names in this fund. So if I look at the sort of largest exposures in risk terms, that it's just 353 of them is a hell of a lot. Okay, so let's talk quickly about UCITS and or BN90. Should we even bloody care? This becomes the who cares? Well, quite frankly, you should. So any funds which are governed by BN90 and standard portfolios, i.e. non-equity portfolios, are managed by this table 1. And this looks like a very busy slide, but I'm going to break it down into something which is more sort of palatable right now for you. So this is the way we manage CISCA funds and the way the whole industry manages CISCA funds. It's according to table 1. So it gives you issuer exposure limits. Yeah, that's what it is. So that's what that table is. So let's put it into layman's terms, right? So any fund or non-equity fund can take up to 100% exposure to the South African government. That's what it can do. In fact, the All Bond Index has got about 96% exposure to the South African government. It can take 30% exposure to any bank with a market cap of over 20 billion. And it can take, 100% exposures to local banks. Yeah. It can take 100% exposure to the South African Reserve Bank. It can take 100% exposure to any foreign sovereign with a global rating which is better to or equal to South Africa. That's an important point. I'm going to show you how ludicrous that is just now. It can take 10% exposures to any public entity to a total of 100%. And then it can take 10% exposures to listed debt, which have listed debt with listed entities underlying them to a total of 100%. So corporate bonds, as long as those corporates are listed, you can take a 10% exposure to each of those corporates to a total of 100%. So your exposure limit is 10% to a listed entity. Any SPV, you can take a 5% exposure to, but the sum of your SPV exposures has got to be less than 25%. And then it can also take 5% exposures to unlisted instruments to a total. That's what it looks like. So I mentioned global ratings. So as we all know, sitting in this room right now, South Africa is sub-investment global. Yeah, it's not investment grade, it's sub-investment grade. So a lot of people ask me, yes, you're investing in your benchmark is the iTraxx crossover, but that's global sub-investment grade. And my retort to that is always, South Africa itself is sub-investment grade. So if you're scared of sub-investment grade, you should be equally scared of South Africa, which is bizarre. But anyway, right, so there's South Africa with its Ba2 rating, double B minus when it comes to S&P and double B minus and Fitch. So Moody's rated Ba2, which essentially is double B. Remember that you as an investor can invest in anything, any name, any of these names to 100% in your portfolio. So paradoxically, rather than having 100% in South African government bonds, you could have 100% of your portfolio in Paraguay bonds, Greek bonds, Panamanian bonds, Italian bonds, and you would be in compliance. You would be in compliance. Mexican bonds, 100%. Cypriot bonds, Peruvian bonds. I mean, look at some of these names. It's mad. Yeah. Ivory Coast, 100%. Spain, 100%. Poland, 100%. Yeah. And all the way up to AAA, which is Norway and Singapore, Switzerland, and the United States. And there we are. So that's what you can invest in. So let's have a look at UCITS. This is what governs our global fund, because it's a UCITS fund. So this is the 5-10-40 rule in words. Yeah. If we have a look at it in a more simplistic manner, what that says at the end of the day is that a UCITS fund can take only 5% exposure to any counterparty, but it can increase to 10% exposure to that counterparty. But the sum of the exposures have between 5 and 10% must be less than 40%. And then you can have 20% in a deposit-taking institution, a bank, i.e. where you hold your cash. But that must be with all other NCDs and corporate bonds and whatever other exposures you got to that bank, that has to be less than 20%. And then member state exposures. So if you're in a member state, let's just call it, the aforementioned Portugal, you can take 35% in your own government and still be UCITS compliant. That's what it is. So you can see it's a lot more stringent than what I showed you in BN90. Right, to conclude, long-run performance is a patience game. That is a fact. All investments are for the long run. Focus more on long-run performance, not short-run performance. Next thing I've got to say, European credit. These are the numbers. I'm not speculating here. I'm not freaking forecasting. I'm not trying to tell you what's going to happen tomorrow. I'm looking at what happened over the last 16 years. European credit outperformed local equities with lower volatility in rands. Right? It's outperformed with lower volatility. FX basically converges risk. When I say that, everything converges into FX risk. It is a risk reducer sometimes. So if you actually have a look at some of those equity indices and look at those numbers that I produced earlier, some of them actually reduce the risk through coming through the currency. Right. Next thing is our thesis, or what we do, has made its mark. It shows in the rankings. And we haven't side-pocketed anything, ever. Even able exposures. When able went belly up, we had no local able exposure. We had European exposure, but we didn't have local exposure. And that was mark to market on a daily basis. The fund is well diversified, 353 different underlying positions. And it certainly is not, how can I put it, swayed by so-called gut feel or conviction, which I've spoken about how bad that is. I didn't speak about it today, but I always speak about it. When someone talks of conviction, you've got to think about going the other way. BN90 does not protect you from catastrophic loss. It doesn't. No legislation does. The only thing that protects you from catastrophic loss is the way fund managers manage their portfolios. That's what it's about. Yeah. Just remember, the pigs, Portugal, Italy, Greece, and Spain, they were freaking big news 10 years ago. Everyone was talking about them. Now, you can take 100% exposure to any one of those governments, and you still be compliant with BN90. So the question you've got to ask yourself always is, do you trust the managers who manage your money to execute in your best interests? And the best way to sort of work that out is ask people if they've ever side-pocketed anything, should I say, any of their investments. I don't think I've ever seen an equity manager who makes a bad call on something and puts that bad performing equity into a side pocket. But that seems to be the case these days within fixed income and credit. So what is this Dunning-Kruger? Well, it's actually overconfidence. It's people's belief that they are better than what they are. So this is a quote from David Dunning, who is the Dunning-Kruger effect. He actually stated, in many cases, incompetence does not leave people disorientated, perplexed, or cautious. Instead, the incompetent are often blessed with an inappropriate confidence, buoyed by something that feels to them like knowledge. So I've said that, you know, I've been in this game now for quite some time. And the longer I've been in it, the more I realize how little I actually know. I used to be a lot more confident, and then the market basically beat it out of me. So when you hear managers speaking with gusto and confidence, and yeah, I think they might be confusing, yeah, just not really knowing how things work. And that is me finished. Thank you very much for listening to me.
Thanks, Paul. Very insightful indeed. Andrew has been patiently waiting. Andrew, you can start sharing when you're ready. Thanks, Paul.
Full screen. Thanks, Eugene. Thanks, Paul. So what I'm going to talk about today is how the mosquito can outperform the other creatures. And this mosquito here is actually a special mosquito. It's a tiger mosquito. And if any of you have been to Europe, you know the tiger well. It came from Southeast Asia in 2004 and has been slowly taking over Europe. And it's a savage beast. It operates during the day. It bites multiple times. And what's interesting about it is it's got excess DNA. So it's actually learned to survive in freezing climates. So its eggs can survive below freezing temperatures. They can survive dried out for more than a year. It's been an extremely successful little creature. And what can we learn from it? And I think one of the big takeaways is do things differently and adapt and go your own way. And I'm going to chat about a few points. Sorry, let me just stop my timer. So I just got my 15 minutes. There we go. So what can we learn from this, and what do we as Ranmore do differently that allows us to outperform and potentially outperform some of the big fund managers out there with very large resources at their disposal? The first thing that we do is we don't meet management. Why don't we meet management? Well, a few reasons. The first is people become the CEOs of businesses, not because they're kind of very bad communicators. It's usually because they're excellent communicators. They're very good at selling a story. They're very good at convincing people about things, and then possibly that they're good managers. So we want to go and meet management. And in truth, a management of a large corporate are not going to tell you anything different to anyone else. They're going to tell you what you want to hear. They're going to try and sell you their story. Well, we don't want to be sold the story. We would rather just look at the facts. How's this company allocated capital over time? Have management done things that align them with shareholders? Is remuneration excessive or not? We just look at the facts, and we'd rather not meet them. We do read the conference call transcripts, and the great thing about conference call transcripts is they're in text. We can go back and read those things 6 months, a year later, and say, they said this, did they do it? Just look at the facts. And that's why we don't want to be led astray, basically, by management. And I think it's a dangerous thing. Something else we do is, it's funny, we just had a debt presentation, but we avoid companies with excessive debt. Why is that? Excessive debt can be very appealing, particularly to the value manager, because you got this company where you got this thin slice of equity, a kind of slice of hope between insolvency and debt. And you can tweak your model, and you tweak it enough, and suddenly you start paying for debt. The equity just looks extremely valuable. You think, I'm going to make 5 or 10 times my money off the stock if it just comes right. Invariably, those things don't just come right. Because if you think about it, if a company is such a great business and generates such great cash flow, well, how did it end up with so much debt? I mean, if you don't generate good cash flow, you don't end up with debt. And the most important factor we look at is cash flow. So does the company generate strong cash flow throughout the business cycle that are returned to us as shareholders? And funny enough, when I used to be a debt investor, and I'm sure Paul does the same, you look at cash flow. Can this company generate the cash flow to pay off the debt? And that's the big measure of if companies can get into trouble or not. Something else we avoid, highly rated businesses and narratives. Why is that? And I mean, I'm the first to admit there's many highly rated businesses that have continued to do incredibly well over a long period of time. And funny enough, the very unusual thing about the last kind of 10 or 15 years in global stock markets is you've had these businesses which have been very large and very highly rated that have continued to grow very strongly. And that's actually quite an unusual phenomenon. Usually what happens is you get a very successful business that's growing nicely. It attracts capital flows. Okay, it attracts competition. And over time, competition erodes that company's super margin, or suddenly you can't grow at 20% because you're competing with 25 other people. And to be sure, there's some companies like Visa, MasterCard, Louis Vuitton, which have got very strong defensive structures, okay? The problem is they're rated 30, 40 times earnings, and they have been growing strongly. Our concern is that if they stop growing, you've got a very big problem because you'll lose half your money. And the moat is high, but the competition will arrive sooner or later. And if you think about it, I mean, if you think back to kind of, let's say the 2000s, even the kind of 2010 to 15 period, do you remember Intel Inside? So Intel absolutely dominated the chip space. I mean, you couldn't imagine anyone competing with them. It was just not a thing people could imagine. Very highly rated company, okay? What happened? It attracted competition, and now the chip space is highly competitive. And the same thing is with narratives. Be cautious. A recent one that's just played out is Electric cars are growing fast. I mean, so even if you're Tesla dominating the electric car space, but huge competition, huge capital being invested in that space, slowly eroding returns. You look at the raw materials being supplied, nickel and lithium for batteries, people with these huge forecasts, huge demand for lithium and nickel. What happens? Attracted a massive amount of capital into lithium mining, nickel mining. Prices absolutely collapsed. A total disaster. So where is maximum capital flowing towards at the moment? I would say that could be an area of caution. I'd say that one area is the US stock market. Big capital flows into US stock market, and particularly into certain technology spaces. And you know, a lot of people used to think of the chip business as a commodity business, a bad business. And these businesses are currently very highly rated at the moment. Strong narrative. Conversely, the amount of capital being invested into chip fabrication and things like that very high. That could be an area of caution, but it's not an area we invested in. So it's not something we spend an awful lot of time looking at. What we do is we seek out areas where capital is fleeing, okay? I mean, it's funny, Paul mentioned what's they term the pigs, Portugal, Greece, Italy and Spain, I believe, in 2011, where people all thought it was an absolute disaster. When was the best time to buy Greek government bonds? In 2011-12. You would have made, I stand corrected, but I imagine you would have made excess 20% returns from there. Why? Because people were terrified, sold all the assets, very attractive entry point. So you just look where capital's fleeing, and that's what we do. So 2 years ago, our biggest kind of exposures were in Japan. Why? No one wanted Japan. No one wanted it, okay? We found lots of opportunity in Japan. Cash generative companies, paying big dividends, very, very conservatively financed. Perfect, okay? Long-term management in charge. Japan, since Warren Buffett said he liked it, has suddenly become the flavor of the month. We've massively reduced our Japanese exposure. It's done very nicely for us. Where is capital fleeing as we speak today? I'm sure you all know, and that's China. Just 5 or 10 years ago, China was absolute flavor of the month, okay? Now people hate it. Huge opportunity. We can buy little industrial companies with 20, 30-year track records of growth, controlled by the founding shareholders. For the founding shareholders still managing the company, you know he's aligned with you. No share option issuance, well sub 10 times earnings, 7, 8 times earnings, 5, 6% dividend yields. Very exciting. We're not big in tech, but we have actually bought 2 Chinese tech companies, particularly Alibaba and Baidu. And Baidu is a great example of the narrative changing. So in 2010, Baidu's share price is higher than it is today. And Baidu is like the Google of China, if you will. It was trading at 90 times earnings, 90 times earnings. Earnings of Baidu have grown 8-fold since 2010. The share price is down. Why? Well, instead of trading at 80 times earnings, now trades in sub 10 times earnings, 12% free cash flow yield, huge cash in the balance sheet, very attractive. But again, to Paul's point, we're not the kind of people who say we have conviction. We know we can make mistakes. We know we're wrong. So we take modest positions, 2% here, 2% there, 3% there. A very diversified portfolio of very undervalued companies. So importantly, we seek out management who are working for us, who are working for shareholders, not against us. And for me, one of the big indicators of that is incentive structures and share option issuance. And it's one of the reasons can we long-term cautious on the US stock market. Why? A great deal of value goes to shareholders. Okay, an example of a company we actually owned it, we exited, was Expedia, where the guy had this massive share option structure. They then announced a share buyback program of 30% the market cap, which is no way they could do. There's no way they could do it. And we looked at this, was like, this is a big red flag. What's going on here? It turns out he had a holder of share option strikes, and he was trying to push the share price so he could make his share option strikes, made them. What do you do a month later? Resign, cashed out, and went to another company. Okay? The guy at Uber actually did the same thing now. Pushed the share price through share buybacks and struck his options. So If you look at many European, Asian companies, 0 share options, no dilution, okay, which we like. When I talk about management working for shareholders, it's also about making wise capital allocation decisions, wise investments, not going spraying money anywhere in a growth phase. Something else that's very important to us is we have a small team. We're just 4 people kind of as analysts in our investment team. Why? This is a hard business. You need to trust the people you work with. You need their support. If you think of a team of 50, 60 people of highly competitive, usually white men, at each other's throats trying to compete, that's not a kind of structure where you can build support and trust in each other. The other thing is time. We don't have time to manage 20, 30, 40 people. We'd rather just look at the portfolio and look for cheap stocks. And truth, it's far easier for the truth to come out if they're just 4 of you than if they're 44 of you. So we think a small team is the way to go. And why do we only have 1 fund? We have 1 global equity fund. Again, thanks to Paul, you can see actually what's been the outperformer of the long term is global equity. Sean and I, who manage the portfolio, we want our money in global equity. We're not going to go and manage something else. We think global equity is the right decision, and actually encourage you to go and look. A lot of people get trapped and, oh, this is the right tax structure. It's got to be regulation 28, the right tax structure. Got to be in retirement annuity because it's tax efficient. I encourage you to go and look, even for the last 10 years, if you just put your money in global equity, pay the original income tax, rather than putting your money in a regulation 28 balance fund through a RA, and see if you'll be better off now. I think you're probably better off now. The other thing about managing 1 fund, we manage a fund, we don't manage a business. We don't want complexity, we don't want people issues. We just want to look after our global equity fund. Why? Well, our money's in there, and we want to look after our money and grow our money. So what do you get when you invest in Ranmore? You get about 50, what we think are very undervalued, out of favor companies. These are companies spread across the world. We are totally benchmark agnostic. A lot of people, if you want benchmark tracking, you want benchmark cognizance, go and buy a tracking fund. You're far better off buying a tracking fund. If you want something different, if you don't want to be in the big go-go stocks, you want someone who's gone around and selected specific stocks for the portfolio, they pay a decent dividend yield, offer net cash in the balance sheet, well managed, then we for you. And what has that ended up? So Sean started the fund in, I think it was October 2008. So this was before the big collapse of the market. Don't forget the market fell from kind of end of 2008 to in early 2009. Then US CPI of over 8%, doing plus 8% for the last 15 years. I think in pounds sterling, it works out at 6.5 times your money. And in dollars, I'm not exactly sure what the money multiple is, but it's done very well for investors, and it's something we're proud of. Something else, and we're launching a distribution class shortly, is the portfolio as a whole has a 4% net dividend yield, net of withholding taxes, and the portfolio is still growing. For us, we like companies that are growing. We don't like companies that are shrinking. We don't like value traps. So that's what you get with us, kind of no bullshit, straight up, simple portfolio, simple message. That's it for me. I managed to claw back some time, so we've got some time for questions. Thanks, Eugene.
Andrew, thank you so much for that. Very much to the point, and no punches pulled there. Thank you for that. Just very quickly, and you did mention the fund launched 2008. The feeder fund, obviously, a lot younger, launched 2020, but the underlying fund's been going for yonks. And if I look at your performance graph, I mean, you outperformed the MSCI index over mostly all periods, and since inception, you way above. Interesting, the feeder fund, we brought in the word value. So it's a BCI Ranmore Global Value Equity Fund. The foreign denominated fund is just a Ranmore Global Equity Fund, plain and simple. Very often, especially DFMs or asset aggregators tend to try and put a fund manager in a box and, being labeled value. Then you get that debate starting, is it a value or growth cycle? But if you look at your returns, especially over the last 12 months, where markets were dominated by mega caps, you still managed to keep up. And like I said, over time, you beat the MSCI, which is dominated by growth stocks. Is that label value justified? It doesn't matter.
Yeah, so I mean, thanks, Eugene. That's right. So we outperformed the world market last year without a single Magnificent Seven stock, not one. Okay, and
Yes.
and I think since inception, the fund is in the top 3% of global equity funds, something like that. Value or growth? I mean, I guess we'd love to have both if you could. We'd love to have growing stocks, that growing companies are undervalued. That's what we look for. And I would hope that all fund managers, and I'm sure they all tell you their portfolio is undervalued, that we only buy stocks that are undervalued. But I suppose we do fit, as people categorize it, we do fit in the value bucket. We tend to have companies that have higher dividend yields, definitely a lower price earnings multiple, and that is often what people describe as value. That being said, why did we outperform a lot of the other value managers in the recent history? It's because we avoid things where we think earnings are high, and like materials. We never a single materials company last year. Why? Because we thought earnings were high and we were going to come down. Conversely, in 2020, we were full of material stocks. Why? Earnings were low. So it's really about trying to be in the right place at the right time, which we're not always. We make mistakes. We don't make lots of mistakes. The trick is to minimize the loss you get from your mistake and move on, which being a small team and a small company, we can do.
You mentioned as well, you're not benchmark agnostic, being the MSCI World Index. And if I look at your geographical allocation, Sean also presented on that on about 2 or 3 weeks ago. But I mean, just very quickly, and my numbers might not be 100% correct. North America, you're about 20, where the World Index is at 72. So extremely different. You mentioned Japan, healthy holding there of about 16%. Europe, you're sitting on 38, relative to MSCI, roughly at about 20. Why the big allocation to Europe relative to the MSCI and relative to all other general equity managers we see out there?
Yeah, so just to be clear, I might have said we're not benchmark agnostic. We actually are benchmark agnostic, so we don't care about benchmark at all.
Yeah.
Why the big position in Europe
Excellent.
is we find undervalued companies there. So we own some European food retailers, something like Carrefour. It's trading at about 12% free cash flow yield, 8% earnings growing. The management team there have done a great job for shareholders. We also own some European banks. I know you hear these people chatter that, oh, South African banks are so undervalued, they're on X% dividend yield. I mean, we're buying AB and Ambro, fantastic business, 8% dividend yield. ING, growing bank, 6-7% dividend yield. So Europe, again, very out of favor. People hate Europe. I mean, they think it's like slow, kind of befuddled little people with Russia next door. Yeah, I mean, Russia is next door. It's a risk. We know that. But we just find lots of companies that we think, if you look at the company like for like, same ROE, same growth, what would you pay for that business in the US? And what would you pay for that business in Europe? I hazard a guess you'd pay half the multiple in Europe. And that's why we're big in Europe.
Andrew, thanks for that. Paul, I just want to check. I see you on the line still. Question from the audience for you. And it speaks to your global credit, obviously. Why do you prefer European exposure to US?
There's actually a couple of reasons for that. Firstly, our index is a European index. So our benchmark is a European benchmark. I always explain this. If I'm running a financials unit trust, but the majority of my counters or my investments are in IT, I don't think I could call it a sort of the financials fund, could I? So the fact of the matter is that the benchmark for this fund is the iTraxx crossover, which is a European-based credit index. So it would be a bit strange if we had like a sizable amount. Now, what is a sizable amount? Let's just say 40% of our sort of investments were made, and forget about off benchmark. We're talking about off region. We're talking about in a completely different, sort of almost like a different market. So that's the first reason. The second reason is that there's a nasty thing in the US called Chapter 11, where basically, companies are protected from creditors. So companies go in and out of default, in and out of Chapter 11. It's almost like equity friendly, so companies exist at the behest of shareholders rather than at the behest of the debt holders. Whereas Europe, it's different. If companies go belly up, which they do, the debt holder actually is pretty well protected. So, and companies don't sort of revive themselves 2 weeks later, after the CEO, and I'm glad Andrew said what he did. I couldn't agree with him more. Listening to management is just like a crazy thing, because they're going to tell you exactly what you want to hear, and they're pretty good at it. I must tell you that the biggest mistakes I've made within my history has been in listening to, top management convince me that what they were doing had a long-term place within the industry. It was absolute rubbish. They'll tell you what you want. In fact, they'll tell you what benefits them rather than what benefits you. So that's what it's about. Yeah. So again, it's more. I would say that Europe is more debt friendly than the US. US is equities friendly. I mean, that's what it boils down to. Yeah, every turn of the wheel, there's another company going belly up. Whereas, Europe is slightly different. It's also more. I mean, Andrew mentioned this as well. It's like pedestrian is probably a bad term. It's more almost like socialist and capitalist in its ways, which means perhaps there's a lot of companies out there that are sort of kept alive, which is paradoxically becomes good for the debt holder and bad for the equity. So it's more debt friendly. And then the last one is it's in the same time zone, and there's enough opportunities within Europe besides having to look in Japan and all these other places for us. So that's why we do that. I hope that answers your question.
It does, Paul. Thank you for that. Just one last question, maybe. I found that slide you had on, how the investor works with the currency. You come in with ZAR, you invest in underlying euro. Obviously, you pay out in ZAR, and it's always a question from a South African investor perspective. We know that the global exposure in BCI Income Plus, that is hedged. In Global Income Plus, if you buy directly into the feeder fund, there's no currency hedge, so you get the benefit or not from currency. But your base currency being euro, and you also mentioned FX risk. We know that the dollar is too strong. We know the rand is too weak, but we also know that the euro is undervalued relative to the US dollar, like most other currencies in the world. So hypothetically, if the dollar were to lose steam, or whenever, would euro then benefit relative to the dollar? And in so many words, if I'm an SA investor in the feeder fund, also benefit the fund?
Look, I'm going to answer that in a sort of roundabout way. I don't know anyone who knows anyone who can actually accurately value and trade currencies. Let me just say, I don't. If there was somebody out there that could do that consistently, not one-off, not like, oh, this is going to happen now. I'm talking about consistently, day in, day out, making money out of it. It'd be a multi-trillionaire. I don't know anyone that can do it, right? So that's to start with. So this speculation about what's undervalued and overvalued with currencies, let's see. Who knows? The market can be quite irrational for quite a long time, and you're not. You'll get sweated out of your position, so you'll become insolvent. That whole story about which was said. But anyway, so yes, when I talk about FX currency being hedged, again, this is not a currency play. I just want to say it right. So let's just. And that's why we hedge currency in BCI Income Plus. It's not a currency play. It's a credit play. And I don't want that risk domination. So we go now into the euro-denominated fund, the same thing happens. So it has US and pound investments. Those are hedged back to euros because it doesn't want to be a currency play. So so there's FX futures in there which bring everything back. So irrespective of what the US dollar or the pound does vis-a-vis the euro, we've got an offsetting hedging position which takes away that risk. But then
Thanks.
when you invest in the global feeder fund, you are taking that FX risk.
Yes.
I would argue that, you know, sometimes people want it, and they want to diversify through currencies as well as assets. So that's why the feeder fund is not hedged. It isn't hedged. It's not hedged between euro and rand. So it's left floating, yeah. Which is why that feeder fund has much higher volatility than the income plus fund, and that's primarily thanks to the fact that its FX is left floating, or its FX is not hedged.
Thanks, Paul. One last question. We are very quickly running out of time here. There's a couple of open questions from the audience. Andrew, it speaks to, you mentioned your team, a small dynamic team for all the right reasons, works for your business, and it's evident in your fund performance. But how do you think about key man risk in your business? I mean, senior partners, you and Sean, and you know, again, it's always something investors have to think about. How do you mitigate for that?
I think people overplay it. I mean, so if Sean tragically died tomorrow, I would take over, and vice versa. If we both fell off the twig tomorrow, well, then if investors don't like it, they can sell their units the next day. You know, every stock in our portfolio can be sold in like 2 or 3 days, gone in cash. And we still got our ops people, we still got people who can do that. So if we both tragically die tomorrow, you can sell all your units and take your money elsewhere. But you know, hopefully we're quite young and healthy, that won't happen. And there are 2 of us. And we have other people working for us.
Paul and Andrew, thank you so much for your time this morning. It's been really, really insightful indeed, like always, and we're really grateful for your time. There's a couple of questions from the audience wanting to know more about your funds. All the information is on the Boutique Manager's website. If you're not sure where to find that, get hold of any of the BCI team members and we can get you directed that way. Fairtree also have people on the ground in SA, so if you want to get hold of them, we can put you in contact. And I know the Ranmore team as well, if you need more information, they will gladly assist you as well. Gentlemen, again, thank you from our side for your time this morning. We will chat to you in the very near future. To our audience, quick reminder, next week, Wednesday, Granite Asset Management on fixed income and Battelier Capital on SA equity. That's unfortunately all the time we have this morning. Thank you again for your contribution in making our business a great success, and we hope to bring you more insights as we progress. Thank you very much.